Good evening once again. I'd like to encourage you guys to keep time. So we are talking about order blocks today. We have made a brief introduction on order blocks, but for the benefit of those who just joined us into the meeting, we have elaborated that order blocks are the key concepts being used by the institutional or the big banks. It's the order blocks. They are of three main categories that are very important into the market. Somebody may be asking, what are order blocks? The order blocks, I will simplify it by saying it is the one last candle before the market actually moves to a certain direction. The order block is identified by the last candlestick before the market actually moves to a certain direction. It might take a bearish direction, or it might be taking a bullish direction. But before the last candlestick, meaning we experience the candlestick and there is this special move we need to observe so that we can say this is an order block. And that order block is able to assist us. It assists us to identify the future moves of the market. We use the order blocks to identify the future moves of the market, the future direction of the market. The order blocks are mostly beneficial when you are identifying them on bigger time frames. I repeat, the order blocks are mostly beneficial when you identify them on bigger time frames. So I hope that does make sense. I want to explain why is it important to know more about the order blocks. The order blocks, these are moves of the market, the false movements of the market being used by brokers, being used by the institutional traders to manipulate the retail traders. I hope people, they do understand. So, okay. There are three main types of order blocks. Three main types of order blocks. The first one is the downtrending structure order block. The second one is a retail logic structure order block. The third one is SMC logic structure order block. The SMC is the smart money concept order block. So those kind of these are the three very important types of order blocks. We will be introducing them today, and further during the course of the week we will go deeper and show that every one of you is able to utilize the order blocks, is able to identify them and benefit after they're drawing the actual and the real structure of these order blocks. So I hope now you have a clue, even though you don't have a clue. So guys, the downtrending order block, it is identified when the market has been bullish for a long time, or the market has been bullish and suddenly it will show one engulfing bearish candlestick if that candlestick is engulfing and at the highest market price, that is our order block. We use that order block to identify our sell and our future buys or sells. I hope you do understand. So the retail logic, it's almost similar with the downtrending structure, but mainly we specialize on buying in this case. And also the smart money concept logic, that one is completely different from the other ones. The smart money, it's when the price is coming back from the previous order block. So this is entered through liquidity of the blocks. I hope that does make sense. So to give you a just a brief clarity on the retail logic, the retail logic must always be engulfed by the next candlestick. Like this is the first candlestick, this is the second one, and the second candlestick should engulf the first candlestick. Like this is the first candlestick, this is the first, we will say this is the main candlestick, this is the first candlestick, and this is the second candlestick. The second candlestick must engulf the main candlestick, not the must engulf the first candlestick, not the main candlestick. I hope that does make sense. So that is a brief introduction on order blocks. Let's continue. But I would like to emphasize that if you happen not to understand the demand zone on the resistance level, the major resistance level, the minor resistance level, the supply zone on the support level, and also the major support, the minor support. Listen, here we are taking a different route, because there we wanted the good entries for long-term traders, but the order blocks, we want the entry in between of the charts, between the price of the market. We want the entry between the price of the market. So like we say, on the first order block, I hope you can see my chart. On the first order block, we are mostly interested to that the price of the market, it has to go down. The price of the market has to go down. We are observing the candlestick here, so that the price should go down. You see, and also, for instance, this is our demand zone. But before we pull the trigger or before we are late in the market, we need to identify the order block here so that we can enter and go down. The earlier the entry, the good profits you're making. Because if we identify the order block on top here, it is easy for you to place a stop loss just above the wick, WIC, okay, above the wick of the candlestick. That is when we put our stop loss. But the benefits of using the order block is that we don't need to wait for a complete demand zone or a supply zone. But for the order block, we only draw one straight line. And then we wait for the candlestick to form after the second one, it forms, or the second candlestick, after it forms from the main one, which was bullish, then the first one, then the second one, that is going to be bearish. That is when we place our sell. So it's very important for you as a trader to know an order block. It's very, very important. Here is the just I think I have 4 or 5 slides to introduce the order blocks. Here is a question: how to use order blocks. You enter the stop loss just above the wick, just above the wick, just above, so close. But personally, I would suggest you don't enter earlier. You need to give it time, and then so give the market the breathing space. Don't put the market into pressure, because the market is never under pressure, but you are under pressure since you need money from the market. You don't put the stop loss just on top of the wick, but give it time. Okay, give it some time. So the stop loss we insert using the order blocks, it's very risky, because we don't insert the stop loss using the major levels or the minor levels, but instead we have to be guided by the candlestick wick, the main candlestick wick. That is when we insert our stop loss. That is, we in that way we should put our sell or we put our buy. The things, they are in conjunction. We have order blocks, we have mitigation blocks, and we have the breaker blocks. They are all working together to confuse the trader. That is why sometimes you will be applying the correct principles of trading and finding that you don't achieve the results you are expected to achieve, because the market has been manipulated a lot. So in this case, we must be in a good position to see the manipulations and go against or with the manipulations without losing any money. That is why the order blocks are very important for one to know every day. So okay, discard. So that's it for our order blocks today. I have some images. I've just got some few images to help me explain, making you understand better the order blocks, the concept of order blocks. Remember, we said you should identify the zones. After identifying the zones, you then need to know, when should I enter into the market? When must I enter into the market? Do you see on my chart? Please look on the cursor here. There is a red arrow that is pointing to the right on my screen. You see there is 1, 2, 3, the fourth blue candlestick, which is bullish. Then this second candlestick after the bullish one, the one that is bearish, it is a bearish engulfing candlestick. And that bearish engulfing candlestick, it is an order block. This one, it is an order block. So you draw that order block region. By doing so, you will be able to be in a good position of identifying the false moves of the market. After identifying the false move of the market, it is actually very accurate to mark this region and know that the market, even if it is going to be bullish, it won't go beyond this zone, because the order block is telling us that the market is willing to build a new zone, is willing to build a new zone. So like I said, into our introduction, the order block it assists us to identify the future moves of the market. We think ahead of the market, ahead of the price. We already know that now the price is yet to move here. You see here on the bearish candlestick, there is a doji, an evening star, and here after this candlestick, the evening star, there is this bearish candlestick, which is our engulfing. In this case, it has tested the order block region, which is the very strong region. According to our previous strategy, we'll be saying this is our demand zone. But this here we are talking about order blocks. This is an engulfing, and here we are very much sure that the market is yet to be bearish. And our stop loss, you will put your stop loss on this mark, which is like a star. I hope you can see. You place your sell. You see, the market might play here and it can give you some money. After giving you some money, and it will retrace again or correct the wave, and also the move will continue because still there was no order block. But here the market will then create a support level. You see, this support level, it's a strong level. After creating this support level, and boom, here is another bullish candlestick. I said it must be the first candlestick, the second candlestick. It must be the first, the second, the second candlestick, and then on the third one, that is when we say it must be an order block. But here we wait because the market has showed us this region here to be a resistance level. Remember, we apply everything that we have learned since the beginning of our lessons. Here is a resistance level. You do not buy on the resistance level. What is a resistance level? I repeat, it's an area that has been tested once or twice, actually multiple times, twice too many. And here you wait for the market to retrace. Then when the market is here, it will then go down. Remember, we draw the order block here before the actual move of the market. Like this region is already there. But when the market is coming back here or is retracing or correcting the wave here, we see that now the market is touching our region. After touching our region, we place a buy. We put our stop loss on this mark, the star. Remember, when we're putting our stop loss here, we are showing that now the market is willing to go up further, though it won't go up that much because the order block, like I said, we are looking for entry in the middle of the chart, looking for entry. So we buy and then we wait for the market. Maybe it will retrace, but since it didn't touch our region here, we don't close before we are stopped out. And here, when the bulls have reached our first order block, remember there was no price here. We just sold on the market, and then we bought here. And then when this candlestick is touching our region here, and we close. When it's touching this region, it is corresponding with our previous order block, and then boom, it will go down further. And also it touches this region, that is when we close. It is almost the same with the channels when the market is moving or with channels diagonally. But in this case, we are taking the accurate entry for the future move of the market. We are taking the accurate entry for the future move of the market. I hope it does make sense to everyone. Another picture that I have here is this one. You see, here is an order block. We identify this order block because the market here was bullish. You see this area, though it's a bit faint or blurry, but please try to have a look. There was a bearish candlestick. Instead, we are waiting for the market to give us a confirmation that this is our, we have to take our sell. But seemingly, instead of the market to sell after this bearish candlestick, it just waited here. The price was consolidating, and boom, it simply showed a bullish momentum, another order block. So you buy after you see this momentum, you buy and draw the order block to the sideways. Instead, after buying, you wait for the market. You wait for the market to tell you the further direction. But here it's not clear. It's not clear. When you see that the market, it doesn't gives you any signal, just wait. But here, that is when we see our main order block here, the bullish order block, the bullish momentum. Though here the market tried to manipulate us by giving us one bearish engulfing and another confirmation candlestick that the market is bearish. But in the midst of that, the market showed us a bullish engulfing, meaning that from our next candlestick here, we must be drawing our future move of the market. We are convinced that now the market is going to be bullish. Like you can see by analyzing that our first TP will be on the first resistance, our second TP is second resistance, third resistance. That's how we set our take profits and stop losses. So I think that does make sense. Then our next move, let's check this example again. Here is our another example. You identify the supports, the resistance level, but above all, we want to know when to enter for a sell and when to enter for a buy. You see here, the market, it comes along this way. It comes along this way, upwards, and here, boom, here is an engulfing, a bearish candlestick, and the momentum favored our order block. And because we know that before you enter, you must know where is the support, the resistance level. When you enter here, you already know that your take profit will be here below. That's the major support level. And then I want to go and show you another order block. Though the market here was on the highest market price, you see, on the highest market price, but there was a bullish candlestick though here, and also this second candlestick, we cannot say it's an order block because it's smaller, it's not engulfing. And the third one is, the fourth candlestick is engulfing, which is wrong. It's no longer an order block. We wait for the market to give us what we want. And here is a bullish pin bar. It's another bullish confirmation and one bearish candlestick. The moment it engulfs, it means this is an order block. We open our sell, we put our stop loss just above this arrow and our take profit just here at the support level. That is how we use order blocks. They do make sense, but they won't at all if you don't understand our previous lessons, the support, resistance level, the demand, the supply zones. Let's come here again. This is another picture to illustrate. Remember, how do we identify an order block? The first type of order block, you identify it by seeing an engulfing candlestick. I repeat, you identify an order block by seeing an engulfing candlestick. When you see the engulfing candlestick, you draw that area, the area. Sometimes you will draw that area and find that that is a demand or supply zone. Sometimes you will find that it's not the demand and supply zone, but it will be an order block area where you will be entering the market or exiting into the market. So here are the small examples. It shows you that when the price is here and an order block is identified, the market will take the impulse and go down and retrace to touch the order block region and then impulse again. Like here, when the order block is bullish, the open and engulfing candlestick and the impulse, it will take some rest anywhere below the resistance level and retrace again. So that's it for today. Let me show you other illustrations. Okay, this one is irrelevant. It's a week, something like that, opening, so it's irrelevant. It's for those who are still new in trading. Okay, so my picture is not clearly, but I think you can, let's enlarge it so that you can see what I'm trying to, oh, sorry, oh yeah, you went. Okay, so it's blurry, but I want to show you something here, that when you identify the order, Jesus Christ, please mute your mics. Mute your mics, guys. Be matured. Okay. Please mute your mic. I have the hope that everyone inside here is an adult. Please mute your mics, guys. You are interrupting us. Thank you. Okay. Like in this picture, I want to show you that the order blocks will assist us to obtain the future price movements. The order blocks. You see, this trader will have identified the sell position here by identifying order block, and the momentum was good, but all along the market encountered a very strong support level, and it decided to consolidate and retest this level multiple times. But when it started to buy, he already knew that the market, even if it can buy, it won't go beyond this order block area, and then after this area, the market has to retrace again or correct the wave and go down. This is how the order block is helpful to you as a trader. So always know that the order block is there to assist you knowing when to enter, then when to exit in the market. When the market, you find the market is in the middle of the market is in the middle of the price. It's no longer at the supply or the demand, but you use the order block to trade. Like here, we have identified, okay, the trader have identified the order block on this region. Here is a bullish pin bar, and here is the bearish the bearish engulfing, and also here is a bullish and the bearish is no longer engulfing. That is why here it is not an order block, because the bearish has engulfed the third candlestick, which is wrong. We want the bullish and it must be followed by the bearish engulfing. Then we say it's an order block. Then you draw the zone to the right hand side. After drawing the zone, you just leave it hang, or you hang there, and then you place your sell and identify your support there to make your stop loss. And here, where you will see by another order block when the market is ready to go up, and then boom, you buy, or your take profit will be on the pre-order block zone that you have drawn before. Your stop loss will simply just be above the wick. That is what we call the order block entry and exit. So I think this will be our last picture. I'm not taking questions for now because our lesson will be broadcasted. Okay, so this is our next picture, though it's not a bit clear, but you can see the concept that here is our second type of order blocks, the SMC. Okay, this is our the price here is bullish, and also here it's the first bearish. The first bearish is considered because it is a return from the highest price. Okay, then after the return from the highest price, there is a long candlestick, which is a bearish continuation. That is when we draw our order block here. We draw it before the price goes down, before the price can retrace to the order block zone. And in this case, we're able to see the sell, and in this area, we identify our supply major level, the supply zone, the major support level, and then we wait for another signal to purchase, and our take profit will be on this order block zone. I hope that does make sense. So yes, okay, we will take some questions with our next session. For now, thank you, ladies and gentlemen, for your attendance. You can subscribe into our VIP channel, our YouTube channel, our free Telegram channel. We also have our website where you can contact us for any services pertaining trading and also pertaining the payment agent services with Derive. So thank you so much for your attendance. Thank you so much for your attention. Thank you. Bye-bye.